The year 2024 has been a turbulent one for financial markets, with investors navigating a complex landscape of geopolitical tensions, inflation, and fluctuating interest rates. In these times of uncertainty, precious metals like gold and silver often emerge as safe havens, attracting investors seeking stability and wealth preservation. However, the price trajectories of these two metals have diverged significantly, painting a tale of contrasting narratives. Gold, the quintessential safe haven asset, has maintained a relatively stable price trend throughout the year. This steadfastness reflects gold's enduring appeal as a store of value, particularly during periods of economic and political turmoil. Investors apprehensive about the global outlook have sought refuge in gold's historical resilience, bolstering its price amidst market volatility. Silver, on the other hand, has exhibited a more volatile price pattern, characterized by sharp swings and pronouncements of both bullish and bearish sentiment. This volatility stems from silver's dual role as both an industrial metal and an investment asset. While industrial demand for silver remains robust, particularly in sectors like green technology, investment demand has been more fickle, influenced by shifting market sentiment and speculative trading. The contrasting price movements of gold and silver underscore the unique dynamics at play in the precious metals market. While both metals offer a hedge against inflation and financial instability, their distinct demand drivers and supply constraints contribute to their divergent price performances. Understanding these factors is crucial for investors seeking to navigate the complexities of the gold and silver markets in 2024 and beyond. The year 2024 has been a tumultuous one on the geopolitical stage, marked by escalating tensions, regional conflicts, and a pervasive sense of uncertainty. These events have cast a long shadow over the global economy, fueling inflationary pressures and prompting investors to seek safe havens for their wealth. In this environment of heightened risk aversion, gold has emerged as a beacon of stability, its price buoyed by its historical role as a hedge against geopolitical and economic storms. The appeal of gold as a safe haven is deeply rooted in its history. For centuries, gold has been a highly sought-after asset, valued for its rarity, durability, and intrinsic value. Unlike fiat currencies, which are subject to the whims of governments and central banks, gold is not beholden to any single entity or political system. This independence from government control makes gold particularly attractive during times of political instability or war, when investors fear the potential for currency debasement or confiscation. The current geopolitical climate, marked by rising tensions between superpowers, territorial disputes, and the threat of conflict, has created fertile ground for gold's safe haven appeal to flourish. Investors, wary of the potential for these conflicts to escalate and disrupt the global economic order, have flocked to gold as a store of value that transcends political borders and the vagaries of the financial system. Moreover, the inflationary pressures that have gripped the global economy in recent years have further bolstered gold's allure. Inflation erodes the purchasing power of fiat currencies, making assets that retain their value over time, such as gold, increasingly attractive. As central banks around the world grapple with soaring inflation, investors have turned to gold as a hedge against the erosion of their wealth, driving up demand and supporting its price. The actions of central banks around the world have played a significant role in shaping the gold market in recent years, particularly in the wake of the 2008 financial crisis. As central banks grappled with the fallout of the crisis, they embarked on unprecedented monetary easing programs, slashing interest rates and injecting trillions of dollars into the global financial system. These actions, while intended to stimulate economic growth, also raised concerns about inflation and the long-term stability of fiat currencies. In this environment of monetary expansion, central banks, particularly those in emerging markets, turned to gold as a way to diversify their foreign exchange reserves and hedge against the perceived risks of holding large amounts of US dollar-denominated assets. The trend of central bank gold buying gained momentum in the years following the financial crisis, with countries like China, Russia, and India emerging as major buyers. This shift towards gold accumulation by central banks reflects a growing desire among some nations to reduce their reliance on the US dollar as the dominant reserve currency. This trend, often referred to as de-dollarization, is driven by a number of factors, including concerns about US economic and political instability, as well as a desire to create a more multipolar global financial system. Central bank gold purchases have provided a significant source of demand for the yellow metal, contributing to its price appreciation in recent years. As central banks continue to diversify their reserves and hedge against geopolitical and economic risks, gold is likely to remain a key asset in their portfolios, further supporting its long-term value. The U.S. Federal Reserve, as the world's most powerful central bank, wields significant influence over global financial markets, and its monetary policy decisions have a ripple effect on asset prices, including gold. In recent years, the Fed has faced a delicate balancing act, attempting to navigate a path between supporting economic growth and containing inflation. This balancing act has created volatility in the gold market, as investors closely scrutinize the Fed's every move for clues about the future direction of interest rates and the value of the U.S. dollar. When the Fed raises interest rates, it tends to put downward pressure on gold prices. Higher interest rates make it more attractive for investors to hold U.S. dollar-denominated assets, such as Treasury bonds, which offer a guaranteed return. This increased demand for dollar-denominated assets can lead to a strengthening of the U.S. dollar, which in turn makes gold, which is priced in dollars, more expensive for holders of other currencies. Conversely, when the Fed cuts interest rates or signals a dovish stance on monetary policy, it can be bullish for gold. Lower interest rates reduce the opportunity cost of holding gold, which does not pay interest, making it a more attractive investment. Furthermore, expectations of loose monetary policy can weaken the U.S. dollar, making gold more affordable for buyers using other currencies. The Fed's ongoing efforts to combat inflation have created uncertainty in the gold market. While rising interest rates typically weigh on gold prices, the persistence of inflation has fueled safe haven demand for the metal, providing a countervailing force. Investors are closely watching for signs that the Fed is gaining control of inflation, as this could prompt the central bank to pivot towards a less aggressive monetary policy stance, which could be supportive of gold prices. Section 5. Navigating the labyrinth of gold supply. The supply side of the gold market is as intricate and influential as its demand dynamics. Unlike most commodities, gold production is not solely driven by current demand, but by a complex interplay of geological factors, technological advancements, and geopolitical considerations. Understanding these supply-side constraints is crucial for investors seeking to gauge the long-term trajectory of gold prices. Gold mining is a capital-intensive and time-consuming endeavor. Discovering new gold deposits and bringing them online can take years, if not decades, of exploration, permitting, and development. This lag between exploration and production means that the supply of newly mined gold is relatively inelastic in the short term, making it difficult for miners to quickly ramp up production in response to rising prices. Adding to the complexity are the environmental and social challenges associated with gold mining. Extracting gold from the earth often involves the use of toxic chemicals and can have significant environmental impacts, particularly on water resources and biodiversity. As a result, gold mining operations face increasing scrutiny from regulators and environmental groups, leading to stricter permitting processes and higher operating costs. These environmental and social concerns are further compounded by geopolitical risks in key gold-producing regions. Political instability, resource nationalism, and conflicts can disrupt mining operations, leading to production shortfalls and supply chain disruptions. For example, geopolitical tensions in regions like Africa and South America, which account for a significant portion of global gold output, have the potential to impact supply, potentially leading to price spikes. Despite these challenges, advancements in mining technology and exploration techniques continue to shape the landscape of gold supply. Improved exploration methods, such as three-dimensional geological modeling and advanced drilling techniques, are enabling mining companies to discover new deposits and access previously inaccessible reserves. Furthermore, innovations in mining technology, such as autonomous mining equipment and digital mine optimization, are enhancing efficiency and reducing the environmental footprint of gold production. Section 6. Silver's double life. Industry and investment. Silver, often dubbed the poor man's gold, shares some similarities with its precious metal counterpart, but its journey in the market is distinct, driven by a duality of demand, industrial applications, and investment interest. This dual nature makes silver's price movements more intricate, influenced by both the cyclical nature of industrial demand and the often fickle sentiment of investors. Unlike gold, whose primary use case lies in investment and jewelry, silver boasts a diverse industrial portfolio. From electronics and solar panels to medical devices and water purification, silver's unique properties, high electrical and thermal conductivity, reflectivity, and antibacterial qualities, make it indispensable across a vast array of sectors. This industrial demand forms the bedrock of the silver market, accounting for a significant portion of its consumption. In recent years, the burgeoning field of green technology has emerged as a key driver of silver demand. Solar panels, a cornerstone of the renewable energy transition, rely heavily on silver paste as a critical component. As the world accelerates its shift towards sustainable energy sources, the demand for silver in solar panel production is projected to soar, potentially putting a strain on supply and influencing price dynamics. Beyond its industrial applications, silver also attracts investors seeking a hedge against inflation and economic uncertainty. Historically, silver has exhibited a strong correlation with gold prices, often moving in tandem with the yellow metal during periods of market turmoil. Investors view silver as a more affordable alternative to gold, particularly during bull markets when the price of gold reaches lofty heights. However, silver's investment appeal is not without its caveats. Its price movements can be more volatile than gold, influenced by speculative trading and shifts in investor sentiment. Additionally, the industrial demand for silver can be cyclical, subject to fluctuations in economic growth and manufacturing activity. These factors contribute to silver's reputation as a more volatile asset compared to gold, attracting investors seeking higher potential returns, but also willing to stomach greater price swings. Section 7. The silver roller coaster, volatility and trends. Silver's price journey in the market is not for the faint of heart. It's a roller coaster ride, often characterized by dramatic swings, sharp rallies, and sudden dips. This volatility stems from the unique confluence of factors influencing the silver market, making it a playground for both seasoned traders and those seeking to capitalize on short-term price movements. One of the primary drivers of silver's price volatility is its dual nature as an industrial metal and an investment asset. Industrial demand, while providing a steady baseline, can fluctuate based on global economic conditions and technological advancements. For instance, a slowdown in manufacturing or a shift in technological paradigms could impact silver's industrial consumption, sending ripples through the market. On the investment front, silver is often seen as a more speculative bet compared to gold. Its lower price point makes it accessible to a wider range of investors, including retail traders who may be more susceptible to herd mentality and emotional trading. This can amplify price swings, particularly during periods of market uncertainty or when speculative fervor grips the market. Adding to the volatility is silver's relatively smaller market size compared to gold. This means that even relatively small changes in supply or demand can have an outsized impact on prices. For example, a large purchase by an institutional investor or a supply disruption at a major mine could send shockwaves through the market, leading to significant price fluctuations. Despite its inherent volatility, discerning investors can identify trends and opportunities amidst the silver roller coaster. Analyzing factors such as industrial demand indicators, technological advancements, and investor sentiment can provide valuable insights into potential price movements. Furthermore, understanding the interplay between silver's industrial and investment uses is crucial for navigating its price swings and identifying investment opportunities. Section 8. The silver squeeze, supply and recycling. In recent years, the concept of a silver squeeze has gained traction among some investors, particularly those active on social media platforms. The idea behind a silver squeeze is to create a surge in demand for physical silver, overwhelming the available supply and driving up prices. Proponents of this strategy argue that the silver market is manipulated by large banks and institutions, and that a coordinated effort by retail investors could disrupt this manipulation and expose the true value of silver. While the feasibility and potential impact of a silver squeeze are debatable, the underlying dynamics of silver supply and demand are worth examining. Unlike gold, which is primarily held in investment form, a significant portion of silver is consumed in industrial applications. This means that the available supply of silver for investment purposes is relatively smaller, potentially making it more susceptible to price spikes driven by short-term supply-demand imbalances. Furthermore, the recycling of silver plays a crucial role in meeting global demand. Silver is often recovered from scrap electronics, industrial byproducts, and other sources, providing a secondary supply stream that helps to offset the depletion of primary silver mines. However, the efficiency of silver recycling can vary depending on factors such as technological advancements in recycling processes and economic incentives for recycling. The increasing use of silver in green technologies such as solar panels and electric vehicles is another factor to consider when assessing the long-term supply-demand outlook for silver. As the transition to a more sustainable global economy gathers momentum, the demand for silver in these applications is projected to grow, potentially putting pressure on existing supply chains and incentivizing increased mining activity and recycling efforts. Section 9. Gold versus silver factors to consider. When deciding between investing in gold or silver, several factors come into play. Investors should carefully weigh their investment goals, risk tolerance, and understanding of each metal's unique market dynamics. As discussed, silver is known for its price volatility, making it a potentially higher risk, higher reward investment compared to gold. Investors comfortable with price swings and seeking potential for outsized returns might lean towards silver. Those seeking stability and a long-term store of value might prefer gold. Silver's significant industrial use adds a layer of complexity. Economic slowdowns can dampen silver's price due to reduced industrial demand. Conversely, technological advancements requiring silver can boost its price. Gold, less reliant on industrial demand, offers more stability in this regard. Silver's lower price per ounce makes it more accessible to smaller investors. This lower barrier to entry can be enticing, allowing for portfolio diversification with a smaller capital outlay. However, investors should remember that lower price doesn't necessarily equate to better value. Short-term traders and speculators might find silver appealing due to its volatility and potential for quick profits or losses. Long-term investors seeking a hedge against inflation and economic uncertainty might favor gold's historical stability and reputation as a safe haven asset. Both gold and silver are influenced by investor sentiment, particularly during times of economic uncertainty. Understanding market psychology and factors driving investor behavior can provide valuable insights when making investment decisions. Ultimately, the choice between gold and silver depends on individual investor circumstances and goals. Conducting thorough research, understanding the risks and rewards of each metal, and carefully considering your investment objectives are crucial steps in making an informed investment decision. Section 10. A glimpse into the future, gold and silver outlook. Predicting the future of any market is a fool's errand, and precious metals are no exception. However, by analyzing key trends and potential catalysts, we can glean insights into the factors that might shape the outlook for gold and silver in the years to come. The health of the global economy will undoubtedly influence the trajectory of precious metals. Continued economic uncertainty, geopolitical tensions, and inflationary pressures are likely to bolster the safe haven appeal of both gold and silver. Conversely, a period of sustained global growth and stability could dampen demand for these metals as investors shift towards riskier assets. The actions of central banks, particularly the U.S. Federal Reserve, will remain a key driver of precious metal prices. Continued monetary easing and a dovish stance on interest rates could be supportive of gold and silver, while a move towards tighter monetary policy and higher interest rates could exert downward pressure on prices. The evolving landscape of technology will influence the industrial demand for silver. The growth of green technologies, such as solar panels and electric vehicles, is expected to drive significant demand for silver, potentially leading to supply constraints and price appreciation. Investors should closely monitor technological advancements and their potential impact on silver's industrial consumption. Geopolitical instability and conflicts have historically been bullish for precious metals, as investors seek safe haven assets during times of uncertainty. The ongoing war in Ukraine, tensions in the Middle East, and the rise of China as a global power are just a few examples of geopolitical risks that could impact the outlook for gold and silver. Investor sentiment and speculative activity will continue to play a role in shaping the price trajectories of both metals. Factors such as inflation expectations, Currency fluctuations and the overall risk appetite of investors will influence demand for gold and silver, contributing to their price volatility. Section 11. Conclusion. Navigating the precious metals market. The world of precious metals is a complex and ever-changing landscape, influenced by a confluence of economic, geopolitical, and technological factors. As we navigate the uncertainties of 2024 and beyond, gold and silver are likely to remain attractive investment options for those seeking to preserve wealth, hedge against inflation, and diversify their portfolios. Gold, the enduring safe haven, is likely to continue to benefit from its historical role as a store of value during times of economic and political turmoil. Central bank accumulation, geopolitical risks, and persistent inflation are factors that could support gold prices in the years to come. Silver, with its dual role as an industrial metal and an investment asset, presents a more volatile but potentially rewarding investment opportunity. The growth of green technologies is expected to drive significant demand for silver, potentially leading to supply constraints and price appreciation. However, investors should be prepared for silver's price swings and the cyclical nature of industrial demand. Ultimately, the decision of whether to invest in gold, silver, or both depends on individual investor circumstances and goals. Conducting thorough research, understanding the risks and rewards of each metal, and carefully considering your investment objectives are crucial steps in making an informed investment decision. As with any investment, diversification is key, and precious metals should be viewed as one component of a well-balanced portfolio. Do your own research. Don't miss a notification and subscribe. Thank you.